right, and I'll turn it over to Jenna.
All right. Well, thank you very much, Liz. I, like Jocelyn, also work at St. Mary's Bank. I've been with St. Mary's for 7 years and I am in the training department. So I train all incoming retail staff, but have a knowledge and love of education. And I'm very excited to share some of our information that we have with the community that frequents the Derry Library. So I am going to talk tonight about demystifying credit. And we're going to talk about different things like what is your credit score, what makes up your credit score, how to improve your credit score. Also talk about different card types. Are you using the right card for the right purchases? And then if you have a card, how do you make sure that you use that properly? So I am going to share my screen now, and we have a great presentation called It's a Money Thing. So those are the PowerPoints that we have put together that I will present to you guys tonight. So the first session that we have is something called the breakdown of a credit score. And you'll notice that the It's a Money Thing program uses some adorable animations. We have our little credit score chipmunk down in the corner here. And before we had credit scores, there was really no standard for measuring the risk that a financial institution would have for doing lending to somebody who wouldn't pay them back potentially. And by not having that, it was up to individual lenders to make a judgment call on their loan applicants. And as you can imagine, when it's up to one person's judgment, that's how unfair and deceptive lending practices came into play. We would only lend to people who lived on this side of town or something like that. So the adoption of credit scores has really helped to cut back on those types of deceptive practices. So what is your credit score? It's really just a number that's used by financial institutions and credit card companies to determine the risk level that you are when issuing a loan or a credit card. Most financial institutions use a FICO score, and this is very common in North America. It was introduced in 1989 by the Fair, Isaac and Company. So you can see how that kind of breaks down the word FICO if you've ever wondered how that came about or where it comes from. But of your FICO score, there are 3 credit bureaus that report a score. We have Equifax, TransUnion, and Experian. So each credit bureau has its own formula that it uses to calculate this score. So your FICO score could vary depending on which bureau is supplying the information. So if you go to get a loan and one auto dealership is telling you you have a score of 800 and the next auto dealership is telling you you have a score of 750, it may just be that it's different bureaus reporting and not that your credit score did just dip down 10 points from 1 mile to the next. And so I just mentioned score, but what does your credit score really mean? And there is this median and a great measurement of the varying degrees of credit score. So you can see how most credit scores chart between 300 up to 850. And that's the FICO score model. So it could, vary depending on the credit bureau that's reporting. So if your score is between a 300 to a 580, that would be considered poor or low score. And this could mean that you're denied credit altogether, that you wouldn't get that loan or the credit card that you've been looking for. If you're in the range of 580 to 740, that's about fair to good credit. So you may get qualified for the loan, but it may mean that you're higher risk, so your interest rate would be higher. So you'll get that new car, but instead of paying the 4% interest rate that they advertised on TV, you may actually be getting something more like 14%. And a score between 740 and 850 is considered very good to exceptional. And this is that sweet spot. That's where you want to be approved for the loans when you need them and get a good competitive interest rate. And why does our score even matter, right? Well, credit scores influence a lot of different things that we do. Maybe you want to go rent a new apartment. Most landlords and rental agencies require a credit score because they want to see somebody with a strong payment history renting their apartment, because that's lower risk that you're going to default on your rent. Perhaps you're looking to get some student loans, or maybe you have a child who you're trying to help co-sign for student loans. Credit score can affect their ability to get approved for those. Car payments are probably the ones that we see most typically impacted. A lot of times we're not looking at our credit score until we're going car shopping. And some companies, even require a credit score for your job application. If you're going to work at a financial industry or something like that, where you are at risk to have people's information, they may require seeing that you do in fact have this strong credit history and credit score. So how do you get that score, right? What calculates to become your credit score? Well, of course, there's a lot of things that come into play to make up your credit score. 10% of it is the mix of credit that you have, the different types of products or loans that you have taken out. Another 10% is on new credit. So how frequently have you had a pull on your credit, or recently? Do you have a new loan? Do you have a bunch of new loans? 15% of it is made up by the length of credit. So how long you've kept these cards open, or how long you financed your auto loan. 30% is the capacity. So you may have a credit line of $80,000, but are you using the full $80,000? Because you should only be averaging less than that if you can, because you've exhausted all the credit available to you. Then you're not going to be able to borrow anymore and your risk is going up. And then 35%, so the most of it, is made up of payment history. So making payments on time is what really is going to boost your score. This is the biggest piece of the pie and the biggest contributing factor in your credit score. As far as capacity, I'm going to show you a formula for how much you should be using of your credit score, but the less you use, the better, right? Maxing out your lines just because you can, just because they send you the offer in the mail that you've now qualified for $10,000. Well, if you only average a $500 credit card bill, don't apply for a $10,000 line, because now you've sucked up that available credit just in this one card, that if you need to go get a new car down the road, that's less available credit for that particular purchase in the future. Keeping cards open for a long time, not just opening something because of the 35% discount that you get at Kohl's for opening a card today, and making sure that if you get a loan, you are keeping it for the term so that that way you have those positive payments and reportings, are other things that will raise your credit score. Having a bunch of new credit lines in a short amount of time can hurt your credit. So if you got a new job and you all of a sudden have this new money and want to go get a new car and get a credit card so you can be buying a whole new wardrobe for this new job, that can impact your score from all that new additional credit going on at once. And notice this includes retail credit cards. So a lot of people forget that that Kohl's charge or Gap or the Home Depot card is still linking to your overall credit score. And that last piece of the pie, which is that mix of credit, is what making sure that you have variable things on your credit, like a revolving line where you make payments and it opens back up, like an overdraft protection or a line of credit. And then other things like installment loans, mortgages, car payments. Those are things that make up a varied mix so that it makes you much more appealing and brings your score up. So how can you track your score, right? I just said you don't want to be going to multiple places to have polls all the time. So you actually are eligible to get one free credit report per year from each of the 3 credit bureaus. So you can go to annualcreditreport.com to sign up for these from each of the 3 bureaus. And again, I don't work for annualcreditreport.com, so I have no affiliations to them. But maybe you can set some calendar reminders to space this out, since you do get 3, within the 3 different bureaus. Do one in the springtime, one in the summer, one in the fall or winter, so that you are tracking your own credit score to see, what has been reported. Is there anything, on there that shouldn't be there? Has something been compromised? You really want to be looking for those types of things. What if your mortgage company has been reporting delinquently on you, even though you've been sending in the payments regularly all along? Those are things that you want to be looking for on your credit report to make sure that it doesn't impact you long term. Some other things that you should be looking for on that credit report would be account openings. Sometimes you'll get promotional things in the mail that say, you've qualified for this card and you never applied for that card. But if you call the number, all of a sudden you're activated because you were only pre-qualified. So those types of things, any account closings that you didn't do, looking at your repayment history and ensuring that you do have a good mix of credit, knowing that that impacts the score that will come out of it. So you won't get your credit score on your credit report. Those are, 2 different things, but you can access them from the credit bureau, generally for a fee. So from TransUnion, Experian, Equifax. You can also get free estimates from places like creditkarma.com. I know a lot of credit card companies and financial institutions are even offering guesstimate credit scores based off your usage. So you can do those occasionally to get an idea of where your score is and if it's gone up or down. And that concludes our first portion on credit scores. The next section that we cover is on boosting your credit score. So you're familiar with what credit is and what your score is. And now let's find some ways to bring that number up. So it's really kind of simple. If you want to boost your score, you should be keeping and maintaining manageable payment history. Consistency is key. Making your regularly scheduled payments is going to be the biggest chunk of the reporting that makes up your credit score. And you can do all sorts of different things to help you if it is one of those things of, oh no, it's the 17th. I forgot that my card was due yesterday. Those little types of things, although you may not have been hit with interest charges, a late fee charge is just a ridiculous thing that you shouldn't have to pay, and that's getting reported on your bureau. You should also consider opening one card at a time and use it for small regular payments. So things like gas are a great example. If you're driving, you're using gas. This was an expense that you were going to have anyways. So start by putting all of your gas purchases on your credit card so that that way you're making the payment for something that you've already budgeted for anyways. Pay your bills on time. That's going to be a great way to boost your credit score and your reporting. It is the most important factor in putting together that score number. And you can take advantage of a lot of different things in order to make sure that you're working hard to pay your cards on time. You can set up email alerts. There are reminder apps where you can put a reminder in for the date that your card's due and have it recur monthly. You can even set up automatic payments, even for the minimum or a set budgeted amount that comes out every month so that you're not missing any of those due dates. When you're trying to build your credit, you should be aware of your borrowing behavior. So you want to understand that relationship between your financial activity and your credit score. So what does that mean? You shouldn't try to carry a balance. Your credit card should be treated as things that you have to pay anyways, not extra income. Keeping your line open but at a zero balance is going to fall into those other categories of mixed and available, so that that way you are still working on building your credit score. Keep your utilization low, and this is the percentage that I was talking about. You should be using or trying to average only 10% of your available credit. So we have some examples here, and I like easy math, and I'm so glad that the math is in there for me. So if you figure out the amount that you charge to your card on average, as well as the limit that you have for each of those cards, add them all together, then you'll see what your total credit card spending is versus your total credit limit. So if I'm using $150 on my $1,000 card and $430 on my $500 card, I'm really using $580 out of a total $1,500 limit. Now that total puts me at a 39% usage of my available credit. So once I'm at a percentage that high, it's going to lessen that part of the pie chart and bring the score down for that type of utilization and pulling in the available credit. So 10%, that's our magic number that you want to try and stay under. You should also try to space out new account openings and closings. If you were to suddenly go and leave this recording and close out all your credit cards at once, that can have just as negative an impact on your score as going and opening 6 new cards tomorrow. So you want to make sure that you do space that out and you do it responsibly and keep the ones that have been positive for you. Try and mix it up. Having a variety of credit will raise your score. So borrowing different product types, like getting a loan, using cards, putting utilities in your name, are all things that help build and raise your credit score as well. Monitoring your credit is something that we talked about, and that's really important. Reading the credit report. So this is the tool that really helps you understand the score that comes up from this credit report. So you want to be requesting 1 per year from each of the 3 credit bureaus. So space those out, set your calendar reminders, maybe mark it on the calendar in the kitchen, so that that way you know that you should be checking your credit report and looking for any sort of fraudulent activity or incorrect reporting. When you request your credit, it doesn't affect your score. You are permitted these 3 per year one from each of the bureaus without any sort of penalty to yourself. So a lot of that was about credit and credit score. What we want to focus on next is cards. And there could be many different cards that you have in your wallet. I'm sure at any given time, most people have one of each of these cards kicking around. Every payment type really does have its pros and cons. You know, how you use each type is going to make a huge impact on your personal financing. Even using cash all the time has its risk, right? If you're only using cash to pay for things, you're not having those reportings on your bureau to bring up your score. And then when you do go for a loan, even though you've never paid a bill late on time, your score may not be that which allows you to get the car that you want or the interest rate that you deserve. So what are the different card types that we generally hear about and see people using? So we're going to compare debit cards versus credit cards versus prepaid debit cards. So your debit card gets linked up to funds that you have in your checking account, whereas your credit card is linked to a credit limit approved by the credit agency that's given you the card. Prepaid cards do not give you access to credit. It's not linked to your checking account, and it can only access the amount of money that has been loaded onto it. As far as approval process, in order to get a personal checking account, you have to meet the minimum requirements that your financial institution will have. But once you meet those requirements, you generally qualify for a debit card. A credit card, you need to be at least 18 years of age to be a primary card holder. And this approval process could also be influenced by many factors, including that credit score, as well as income and steady job and work history. A prepaid debit card has no approval process. Anybody can grab one at any time for any amount that they load onto the card. You have to be aware of the different fees that come with each of these cards. So sometimes a personal checking account may have a monthly fee. These fees tend to be if you aren't maintaining a minimum balance requirement, or maybe if you don't have enough transaction activity, or maybe you have too much transaction activity. So using your debit card could end up costing you if you aren't following the guidelines from your financial institution. Most credit cards have an annual fee, so I wouldn't be surprised if you find a card that you want and it is subject to an annual fee. And a lot of those prepaid debit cards will charge not only an activation fee, but sometimes they'll charge a non-usage fee. So if you activate one of those prepaid Visa gift cards at the checkout, but don't use it and it sits in your wallet for a year or two, every year it's not used, they tick off another activation fee. So when you go to use that $100 card that you've had for 2 years, it could actually be down to $75 because of fees that have been charged for not using it. There could be other things that get tied to card types, overdraft fees if you use a debit card when you don't have the available funds in your account. ATM fees are something that you need to be aware of with debit cards. Looking at the back of your card to see what network your financial institution is linked to can really help you avoid these fees. Most financial institutions belong to a whole network of ATMs and financial institutions, other financial institutions that you can use their ATM without any fees. As far as credit cards, you could be subject to late or missed payment fees. Cash advance fees are a lot of things that people don't think about until they need it and get charged for it. And then, of course, the interest that you pay on any outstanding balances. Prepaid debit cards, we talked about the loading fee. There could be transaction fees. There could be fees if you want to try and get the funds out in cash at an ATM, or those annual or potentially even monthly maintenance fees. As far as your credit score, there's no influence on your ability to have a debit card and maintain your credit score. The two are not linked. Whereas with a credit card, that one does affect your score. But when used responsibly, it can help build your credit score. Prepaid debit cards have no influence on your credit score either. And my favorite thing is the rewards. What do I get back for using this card, right? Some financial institutions offer rewards programs for their debit cards. Maybe you get entered to win a, night out at a concert or something like that if you use your debit card within a certain spending time frame. A lot of credit card companies offer attractive rewards programs. I have both a cashback rewards card and I am a Disney fanatic. So I have a card that helps me earn funds that I can spend in Disney World on my next vacation. Prepaid debit cards don't often offer rewards programs, but there are some out there that do, and then you are being benefited for buying the card, using it at a certain place. For protection, it pretty much goes across the board for debit and credit cards that you cannot be held liable for any unauthorized transaction that happened after you report your card missing or stolen. However, not a lot of prepaid debit cards offer any sort of protection if it's lost or stolen. So if you do get one of those prepaid debit cards as a gift, I strongly urge you to log on to the website attached to it or call the phone number and register it to you so that way if you do have your wallet stolen or misplace it, you can contact this card company and they can shut down the prepaid debit card just as you would your regular debit card or your credit card. You want to make the most of your cards, right? Stay organized. The more cards you have, the more bills you may have. So staying organized with your bills can help you avoid getting late fees or missed payments. You should be tracking your balance so that way you're looking to stay in that under 10% usage range. Lots of financial institutions offer great tools for this. A lot of times you can use a budget tool in your online banking, or you can link in all of your accounts at all sorts of different financial institutions into one online banking portal so that you're only looking and logging into one place. You should be aware of those fees associated with your cards. Make sure to read the fine print. Don't be afraid to call customer service and ask questions. And get to know the features of your cards. It's not all doom and gloom, paying fees and bringing down your score. You could actually be getting benefits that you're not taking advantage of. Maybe if you use your credit card at D'Angelo's to pay for lunch instead of cash, you might be getting double rewards, or using it at the gas station for this quarter, or enrolling in those programs can give you additional benefits that you weren't even aware of. And then our last section that we're going to talk about tonight is using your credit card. And it's really important that you pay your balance in full and on time. That is the best way to use your card responsibly, increase your credit score, and be financially stable in your purchases. There's some benefits to doing that, right? So you're going to build up your credit because all of those positive, timely payments are going to boost your score. That's the biggest percentage that puts in your credit score. And it's going to make it easier when you do need to go for a loan in the future. You avoid paying interest if you pay your bills on time and off. Carrying a balance on your card can sometimes be inevitable, but if you can do that as quickly as possible to get it back down to zero, then your credit card company is not charging you interest, and you are really only paying the purchase price for the items that you bought. Staying out of debt. So sidestepping the cycle of minimum payments and interest charge allows you to use your credit without fear of spiraling into debt. So knowing when your cycle cuts and when your due date is, and making sure that you're paying off your balance completely between those timeframes is going to help you avoid paying any additional interest. Don't pay those late fees. Rule number one, paying your card on time is avoiding that late fee. Any other penalties for missing payments could potentially result in your card being closed. So download that app to set a reminder, set up automatic payments, use bill pay services if your financial institution offers it. Make sure that you pay at least your minimum amount on time. Use those rewards. Don't just let them accumulate and accumulate. Now, I've got to say that my airline miles have been going up since I haven't been able to travel very often. But, making sure that you are enjoying the perks of having the card, especially if you're paying an annual fee for those rewards and perks. Make sure you're familiar with your billing cycle. So most billing cycles range between 20 to 45 days, depending on your credit card issuer. So within that time frame, all the purchases, refunds, additional charges, fees get added and subtracted from your account. And then when the billing cycle closes, you're billed for that remaining balance. And that's what's reflected on your credit card statement. Your statement will show your payment due date, which is generally 20 days from when the cycle closed. And then a lot of them will also offer a grace period. So, you may be hit with a late fee, but you won't start accruing interest until a certain date range. So for your credit card checkup here, do you know when your billing cycle opens and closes? Are you paying your bills early enough to make sure that you aren't getting any interest or late fees? Most credit card online portals, apps, or even if you call in and talk to customer service, will have a summary of total interest or total late fees that you've paid for the year so far. And a really easy way to be responsible with your credit card is to treat it like cash. Only spend for things that you can afford to purchase. So those regular expenses that you've budgeted for, that you have the money for, like living expenses, gas and groceries, utilities, those are things that are going to help you make sure that you are staying within your means on your credit cards. So you should use your credit card, kind of like a mini loan, right? You get advanced this credit line, but you have to pay it back. But pay for things that are within your regular budget and start decreasing your reliance on cards by saving up an emergency or rainy day fund for those additional purchases, so that if you do suddenly have to put 2 new tires on your car, you have this rainy day savings waiting for you, and you don't have to put that purchase that you can't afford right now on your credit card and pay interest. You should not treat your credit card like extra income. I'm a big fan of treat yourself, right? If you want it, you should buy it. That is the worst hole to dig yourself into with credit cards. You shouldn't use your credit card to justify getting that new Michael Kors bag or any sort of other extravagant purchases. And you shouldn't postpone saving money just because you have a credit card in case of emergency. Thank you very much for allowing me to present this information on credit to the Derry Library, Liz. I appreciate that.